Hello, welcome, Julian Adams, and many thanks on behalf of the World Bank for being so kind to agree to be interviewed for our seminar. And so, what we'd like to talk about is your experience as an emerging markets fixed income fund manager. So, based obviously in London. Now, we've known each other for many years, and you've got a long background in emerging markets bonds, fixed income products, initially as a trader but then after a few years, like many people in the sector do, you went off and founded your own investment firm, your own fund, which you started to manage, called Convivo Capital, and that's what we'd like to talk about today. So why don't you tell us a little bit about how you founded Convivo Capital, and what was its investment strategy? What was the vision behind it?
Sure, thanks, Gavin. So I had a slightly luxurious way of starting our own firm and fund, because basically we were sponsored by Aberdeen Asset Management, in the sense that we started the business at Aberdeen and it worked well, and it was starting to grow. And then I'd always had this sort of entrepreneurial sort of idea and spirit of having my own firm. And when things were going quite well at Aberdeen, I managed to have a conversation with the chief exec. I mean, at the time, we had a long-only fund, but it had a performance fee payout. So it was a kind of like a hedge fund kind of fee structure. But Aberdeen didn't have hedge funds. And at the time, the beginning of the 2000s, was the time where the BRICS wave was very popular with investors, and also the hedge fund wave. Hedge funds were this sort of bright new sort of sector of the market people wanted to get involved in. Emerging markets after the Russian crisis were also, the hot sort of new sector, because they were very distressed and there were really high yields available. And they had all the great attributes emerging markets have, which is excess growth or higher growth, good demographics for forward-looking growth for young populations, etc., and high yields, which meant that the opportunity was ripe in the sector for investors to make the most of those. And so, for us to launch as Convivo, we basically pitched that to the Aberdeen management. So, listen, guys, we want to take this into proper hedge fund area, which is not your model, and we managed to cut a deal with them. So, and we'd already started a long-only product for them, which they kept, which is now $14 billion. So it's a kind of win-win outcome in the end. So the idea was that we would avoid the bad credits. So, for example, Argentina defaulted 2 years into the start of our fund. So we had zero Argentina, and we were very light in Latin America at the time. At the same time, there were a lot of countries that were improving from a credit perspective, credit metrics, and getting into the improving credits, and the fastest improving credits means that the risk premium on those bonds will come down the fastest, and you'll get the best total return as a result of that.
So you set up Convivo, you happily managed Convivo for a number of years, and then you went along and then you sold your firm to another big group. So tell me a little bit about that.
Well, we were approached by a couple of companies at the time. Actually, there was this sort of the heyday of kind of the hedge funds that were morphing away from being the sort of startup, small partnerships to becoming more substantial. We managed to grow our assets from 40 million in 2003 to 500 million in 2007. And we were approached by one firm in particular that had a need for expanding. They already had a hedge fund business they wanted to expand, and inorganically expanding by looking to acquire other firms was something that, it's a quick fix, if you like, to asset growth for fund managers. So that made a lot of sense for them. They also had an emerging market debt team already, but one they felt would be re-energized by the addition of an acquisition of our team, for example. So that was the idea of merging those together, was something that worked well for both sides. I was comfortable with, and they were comfortable with. So there was a time and a place about it, kind of thing, which worked very well. And despite the the hedge fund side of things not really working out, they went on to raise another $3 billion of assets in emerging market fixed income. So it was all these experiences for the larger firms have been good, as well as for entrepreneurs like myself.
Okay, so tell me, you're acquired by this group, so you're now part of a wider group. So you're moving back from being a pure entrepreneur to being part of a larger group. So how did it change for you? How did it feel different working for them? What were the extra layers of management that they put onto risk management compliance? How did it change your job being part of a larger group?
Well, it's fine to start with because we had maintained separate offices for a few months, and so we were just got on with what we'd been doing before. And then as the integration sort of got more serious, and we actually moved into their offices, and then our systems migrated to their systems, things changed quite dramatically. I mean, it's possible, especially because I was head of the desk, it is possible. Hopefully things have improved now, but at the time, literally, if I wanted to spend my entire day in meetings, I could have done. And so the levels of obviously productivity, from a personal perspective, obviously there are other members of the team who are like carrying on with their day-to-day roles, and maybe I was stepping more into a management role than just a sort of the main fund management role. So that might have changed the emphasis from, as I say, meetings, risk management, business direction, how you fit in with a much bigger ship, as it were, and the different parts of that ship. So it was quite a culture shock in the sense, although I kind of was familiar with some of that from my previous experience with Aberdeen.
Okay, that's interesting. So it was so you went into this group. There was a bit of a culture shock, and so what happened? How did the story end for you?
Well, it was probably over dramatized by the fact that the global financial crisis occurred and started to get really bad. Say 6 months after we joined. They had a wider hedge fund business, which had about 11 or 12 different strategies. And on the 3rd of January 2008, the main portfolio manager, one of their main hedge funds, resigned. And over the next 5 or 6 months, so way before even the Lehman Brothers had gone bankrupt, the teams were leaving on this hedge fund business. So that caused a dramatic loss in AUM for that side of the business. Notwithstanding, obviously, from an emerging markets perspective, that wouldn't basically have affected the wider business. It certainly impacted our hedge funds because some of the investors were common investors. They saw assets going out of the wider hedge fund business, which had its own separate business head from either the emerging markets or fixed income business, which we were part of. We were being redeemed quite aggressively while the other fund managers were redeeming. So basically, our business was suffering for no fault of our own, but just for a wider business, business issue. And over, obviously having the financial crisis in the middle of that as well, didn't help at all. So within a year, basically our AUM had fallen 90% with those two factors. So that was pretty dramatic.
Okay, well that's a fast story. I'm obviously glad to see that you're still here, even after such an experience. And we know you went on to do lots of other good things. But Jules Adams, thank you very much for sharing some of your really valuable insights with us. And it's going to be of great interest to my World Bank colleagues and the National Bank of Georgia. So thank you very much.
Good, my pleasure.